Good morning, everyone, and welcome to this month's webinar for professional services firms. My name is Louis Keeping, and I'm a Senior Tax Manager in BDO's London Professional Services Tax Team, which is 30 people strong. I'm standing in for Anna Gerald, who unfortunately cannot make today's webinar. For those of you that don't already know, BDO is a global accounting network with over $7.5 billion turnover, providing auditing, accounting, and taxation assistance in over 158 countries across 1,400 offices with 68,000 staff. Today's webinar is to update you on employment and expat tax matters for professional services firms. Our employment tax seminar in August 2016 covered the apprenticeship levy, an introduction to short-term business visitors, employers' accountability, the new intermediary rules, and termination payments. Given the heightened activity from HMRC and the complexity surrounding the new intermediary rules, we subsequently covered this in more detail in June this year. Both of these webinars are available on the professional services sector pages of the BDO website. Today we are covering two very topical subjects, being the new and complex optional remuneration arrangements and also a more detailed look at the short-term business visitors. Our speakers today are Claire Murray, a Director in the Human Capital Team specialising in employment tax. Claire has more than 15 years of experience across a broad range of employment tax areas such as termination payments, employment status, disclosures, HMRC compliance reviews and SAO. Suk Kandola is a manager in the Expat Services Group, having worked in the field for over 5 years. His main focus is on advising professional services firms on the cross-border tax and social security implications of international assignments, working closely with payroll, finance and HR functions to ensure all aspects of the secondment operate in a cohesive and tax-efficient manner. We work closely in the professional services team with today's speakers on a range of clients. You can ask questions during the webinar using the Q&A feature at the top right-hand side of the screen. Please address questions to all of our panellists. We will address as many questions as possible during the webinar, and if not, after the webinar. We will finish within the hour. Over to you, Claire.
Thank you, Louis. Well, good morning to everyone who has joined us today. So for the first part of today's webinar, we're going to take a look at the changes to legislation which have been introduced concerning optional remuneration arrangements. For an overview, these changes are designed to remove the income tax advantages that arise when certain non-cash benefits are provided to employees as part of a salary sacrifice or flexible benefit arrangement, and will be of interest to all employers who provide benefits in conjunction with salary sacrifice or flexible benefit arrangements, but also those employers who provide employees with choice of receiving a cash allowance instead of receiving a benefit. As this is a particularly confusing area of legislation which brings in some new terminology, I thought it would be helpful to provide a brief overview of some key terms. Before I start, however, it's worth mentioning that the term optional remuneration arrangements is typically being shortened to OPRA, and if you hear someone mention OPRA in the context of employees, it's likely they're referring to benefit arrangements than something involving Wagner. So type A arrangements. These are the arrangements that most employers will be familiar with, and under which the employee gives up the right or the future right to receive an amount of salary in return for a benefit. So, for example, the provision of cars, training or medical insurance or pensions in conjunction with salary exchange. Moving to type B arrangements, well, these arrangements are not type A arrangements, but where the employee agrees to be provided with a benefit or chooses to receive a cash allowance instead of a benefit. The usual example might be where an employer offers a company car or an alternative cash allowance. So what's a cash equivalent? Well, this is the benefit value determined under existing employment tax legislation. For example, the value of the benefit for a company car made available to an employer for private use is determined by sort of particular and special employment tax rules. A number of other benefits also have specific rules which set out how they should be valued for employment tax purposes. Where certain benefits aren't subject to particular valuation rules, the general rule is that the value of the benefit is ordinarily the cost to the employer of providing the benefit. Then we look at what is a modified cash equivalent. Well, this is the value of the benefit determined under the new optional remuneration arrangement rules. Amount forgone. This is the amount of salary that is sacrificed by the employee or the amount of cash given up for benefits. So it's the amount of salary that the employee is no longer receiving. And finally, the relevant amount. Well, generally, this will be the higher of the modified cash equivalent, so as we've just described, or the amount forgone. we've touched on those new key terms, we can discuss the changes in more detail. Where a benefit is provided under an optional remuneration arrangement of either Type A or Type B, instead of using the old rules for calculating the benefit, the new taxable value of the benefit will be the relevant amount. I'll just briefly describe this under the key terms. So as a recap, the relevant amount is calculated as the greater of the amount of cash paid given up, so this is now known as the amount foregone, and the modified cash equivalent. Again, we looked at the term modified cash equivalent on the previous slide, and this is the cash equivalent value calculated under the new optional remuneration arrangement rules, and it applies irrespective of how the value of the benefit is ordinarily determined for tax purposes. So as you may recall, I mentioned there were two types of benefits, so those that are taxed under very specific provisions, so cars and vans available for private use and fuel, which have got very sort of specific rules set out in the legislation, whereas the other type of benefits are where there are no specific rules and therefore just general provisions apply, and so it's just the cost to the employer of providing the benefit. An example of that might be private medical insurance. So the OPRA rules apply to both types of benefits. However, in the case of benefits which are taxed under the general rules, the modified cash equivalent will simply be the cost to the employer, so it's the same as under the old rules. Whereas for benefits which have specific taxing rules, the modified cash equivalent is likely to be different to the cash equivalent which had been determined in the past. And in particular, I think a sort of feature of these new rules, it should be noted that any amounts made good by the employee, so that is where the employer reimburses an amount to the employer, these are not taken into account when calculating the modified cash equivalent. However, amounts made good by an employee are subsequently deducted from the relevant amount when determining the amount reported on Form P11D. So it's quite complex. The rules came in from the 6th of April 2017, so for both the new Type A and Type B arrangements implemented after April 2017. However, as the rules will affect arrangements that were in existence prior to the 6th of April 2017, there are naturally some transitional rules. If an arrangement was in place prior to April 2017, the old rules determining the cash equivalent of the benefit will continue to apply to the arrangement until the earliest of, and this is the date when the current arrangement ceases or is modified, varied or renewed, or the 6th of April 2018. But naturally, being tax legislation, there are some exceptions. And the exceptions to this are a company car with CO2 emissions exceeding 75 grams per kilometre, living accommodation and school fees. And in these cases, the date of change will be the 6th of April 2021. So presumably this is because these sorts of benefits typically have lengthy contracts in place which employers may have entered into in respect to these benefits. However, please do note that it is the earliest of the 6th of April 2018 or 6th of April 2021 for the exception, or when a variation takes place. So a variation will include cases when a salary sacrifice arrangement involves any variation to its terms. So, for example, if a new employee enters into an existing benefit arrangement, this will be a new arrangement for that new employee, regardless of whether other employees had already been party to provision of similar benefits. If an arrangement is, say, for the workforce having access to car parking at or near the workplace, the date on which the car parking contract is renewed is regarded as a change to the terms. Also, the annual review of an arrangement when employees decide whether to continue with or leave with an arrangement, so as part of the flexible benefit scheme, this will also be a change for this purpose. The legislation is new and therefore largely untested in practice. However, there are a couple of examples where HMRC have set out situations where they consider that a change has not occurred for these purposes, so for purposes of these transitional rules. And these are, so for in a company car scheme, if a car is replaced due to accidental damage or other circumstances beyond the control of the parties, or where an employee's arrangements alter because the alteration is connected to entitlement to statutory payments, so sick pay or maternity pay or statutory adoption pay, which forces a change to arrangements. And finally, I just wanted to sort of highlight that when necessary, a just and reasonable basis should be used to determine the reportable value. when benefits are partly within the new optional remuneration arrangements for part of the year, or so this could be where a change takes place during the 2017-2018 tax year due to a variation, and therefore the benefit might have to be calculated partly under the old rules and under the new rules. Again, it would not be tax legislation if there were not some items which have been excluded, and there are some specific exemptions from the new rules which mean that the new valuation rules under the optional remuneration arrangements do not apply. And these benefits are cycles and cyclist safety equipment. So there's a limited exemption for qualifying childcare vouchers, exemptions of contributions to registered pension schemes, so that's employer contributions to registered pension schemes, so childcare, so the exemption for employer-provided childcare, counselling and other outplacement services, and retraining courses. So these are some of the most common benefits used by employers in remuneration arrangements, but there are some other limited exemptions too. More recently, actually, HMRC have also confirmed that annual leave provided as part of an optional remuneration arrangement, where an employee gives up some salary in return for receiving additional annual leave. This will also be outside of the optional remuneration arrangements, which is good news. I thought it would be helpful to just have a quick look at the comparison between the old and the new rules. So one of the benefits that will be taxed under the new OPRA arrangements, if it's provided as part of some optional remuneration arrangements, will be a non-cash voucher. So let us take a look at how the legislation works. Firstly, before 6 April 2017, the cash equivalent of the non-cash voucher will be the difference between the cost of provision and any amount made good by the employee, so irrespective that it was provided, for example, in conjunction with salary sacrifice. Whereas moving to the new rules after 6 April 2017, the new taxable value of providing the non-cash voucher as part of an optional remuneration arrangement is the relevant amount, which is calculated as the greater of the amount of cash pay given up, so that's the amount foregone, which we mentioned earlier, or the new taxable value, which is the modified cash equivalent. So it must remember that any amounts made good by the employee are not included when calculating the modified cash equivalent. Instead, any amount made good is deducted from the relevant amount after that has been determined. In the case of vouchers, the benefit value was the cost to the employer, and therefore, in fact, this remains the same under the old rules and the new rules. So having covered, therefore, the principles of the legislation, I thought it would be helpful to work through an example of how the new rules apply to non-cash vouchers in practice. So in this example, we've got Teresa Limited, who has given Sean the opportunity to receive £50 worth of non-cash vouchers each month. And when I've been referring to non-cash vouchers, what I mean is things like retail vouchers. So something which could be used in a store is not something which could be simply exchanged to receive some cash. And this arrangement is under a salary sacrifice agreement, and Sean has agreed to reduce his salary by £45 per month. Teresa Limited has entered into agreement with the voucher provider, and taking advantage of corporate buying power, has secured, so Teresa Limited secured the provision of vouchers at a cost of £45. The cost to the employer is £45. Sean does not actually pay anything towards the vouchers, so that is, he's not making anything good, but he has agreed to a reduction in his salary. So pre-April 2017, the taxable value is the cost to the employer less any amount made good by the employee. So in this case, it's £45, and there's nothing which has been made good. So the cash equivalent is £45. So just to reiterate, salary sacrifice is not a method of making good for this purpose. So in pre-April, the rules would have been that £45 benefit would be reported on Form PLMD, and Sean would pay income tax on that benefit value. If Sean had made good £20, the taxable benefit reportable would be £45 less 20, so which equals £25. See, in practice, it is very unlikely that an employer would agree to both a reduction in salary and to making good part of the cost. Under the new rules effective from 6 April 2017, we need to consider the relevant amount, which is the greater of cost of provision and the amount forgone. that is comparing the £50, which is the amount, the cost of provision, or the £45 foregone. So if Sean had made good £20, that taxable value would be the relevant amount less the amount made good, so either 50 less 20, which equals 30. So in this example, you can clearly see that the taxable value under the new rules is higher than under the old rules. Company cars are subject to specific taxing provisions and to specific rules, and therefore the new rules under the optional remuneration arrangements are slightly modified compared to the example just seen for non-cash vouchers. The new rules also don't apply, they only apply to company cars which with emissions of over 75 grams per kilometre. So actually cars which consider very low emissions are actually outside of the optional remuneration arrangements. So for company cars, the rules are that firstly, the modified cash equivalent has to be calculated, which is shown on the right-hand side of the slide. So it's a question of finding the list price of the car, then adding the cost of any accessories after to the manufacturer's list price, and then applying the appropriate percentage applicable for CO2 emissions, and then make any reductions for days where the car is, for example, unavailable in the tax year. But at this stage, there are no deductions taken for either capital contributions made by the employee or contributions for private use. These are ignored for the purposes of this modified cash equivalent. This figure then needs to be compared to the amount foregone in respect to the car to determine the relevant amount, and which will be the higher value. And only once the relevant amount has been determined should any amounts be deducted for capital contributions made by the employee or private use contributions. But in the case of capital contributions, the amount which can be deducted from the relevant amount is actually reduced by the same CO2 percentage, because otherwise, if the full amount of the capital contribution was deducted, it would actually give a different benefit value to had been the case under the existing rules. What is interesting in the case of company cars provided in conjunction with sort of a cash allowance, if the employee has never received the benefit of a company car, so it's always chosen, could have received a company car, but it's always chosen to receive a cash allowance. In fact, there is nothing to compare to values for the purposes of the optional remuneration arrangement rules. So in fact, the value should just be the cash which is already being put through payroll as a cash allowance. So I just want to quickly summarise. As you can see, these are a number of complex rules to consider, and whilst there are some benefits which have their own particular taxing rules, the basic principles apply whether the benefit is calculated by reference to the cost of the employer or under specific provisions within the tax legislation. And it's just obviously worth remembering that it's now this comparison of the amount foregone and the modified cash equivalent. So they may be a new set of rules, but naturally they bring new challenges to employers. And what we have started to work with our clients and with employers on their arrangements and helping to identify situations where two or more employees are actually receiving the same benefits, but under these new rules are actually taxed differently because of the application of the rules. So possible examples of this are where one employee enters into a salary exchange arrangement for a benefit in kind and another does not. Or one employee is offered a cash alternative in respect of a benefit in kind and another is not. Or where one employee enters into a salary sacrifice arrangement before 6th of April 2017, but another employee enters into the arrangement after 6th of April 2017. So in the future, we'd like to keep coming across arrangements where both employees enter a salary sacrifice arrangement before 6th of April 2017, but one triggers a variation to the salary arrangement contract before the 6th of April 2018 or 6th of April 2021. There are certainly some situations to think about, and particularly during this transitional year, or these transitional years, where both sets of rules need to be considered. So as employers, what should you do? And is this an end to salary sacrifice? Well, one aspect that is clear from this new raft of legislation is that for now, HMRC still has no interest in removing the income tax and national insurance contributions relief from government-sponsored arrangements, so things like childcare vouchers or bike to work. So this is obviously great news. And also additional employer pension contributions provided in conjunction with salary sacrifice are also alive and kicking. So really there's never been a better time to implement salary sacrifice or salary exchange in conjunction with additional employer pension contributions. And as I think just a quick reminder that a pension salary sacrifice where an employee has entered into an arrangement where their salary is irrevocably reduced and in return the employer makes an enhanced employer pension contribution. Salary sacrifice is not subject to pay-as-you-earn, employees or employers' NIC, and the employer pension contribution or the enhanced contribution is not a benefit charged on the employee. So thus, although tax relief would always be due, because it's a pension contribution, as employer contributions to HMRC approved pension plans are not subject to NIC, there is actually an NIC saving of 13.8% for employers and either 12% or 2% for the employee, so depending on the level of earnings, which determines the NIC rate. Whilst on the subject of salary sacrifice, it's obviously worth remembering that when entering into such arrangement, it is essential that there are robust documentation that ensures an employee's salary is reduced prior to the entitlement. So there's this irrevocable agreement to a change to terms and conditions of employment. And ideally, this documentation would also be supported by the employer's handbook and other company documentation. For those employers amongst you that already have salary sacrifice, provide allowance or flexible benefit schemes, we would recommend that these are reviewed to determine the extent of the impact of new rules, and also whether there's a need for any employee communications or need to change current practices, processes or policies as a result of this change in legislation. We should also consider those more ad hoc arrangements that parts of the business might not think of as optional remuneration arrangements. There may need to be some education around the business too. So as you can see, there's a fundamental change affecting employers and employees, and there's some complex rules to navigate, which of course we'll be happy to assist you with. So with that, I will hand you over to Suk, who will now go through the latest thinking in relation to short-term business visitors.
Thank you, Claire. Good morning, everyone. I'm Sukraj Kandola, Tax Manager in our BDO London Expatriate Tax Team. So I will talk to you about my own observations of the trends in global mobility, and I'll certainly attest to both a move towards increasing numbers of short-term business visitors and global tax authorities showing an increasing scrutiny in this area. So to help us bring some framework to this topic, when we speak about short-term business visitors, we are referring to individuals who make a work trip or trips to a different country for a short duration. So for example, a UK-based financial controller travels to his employer's US subsidiary for 2 to 3 weeks every quarter to oversee financial statements of the US business, or an IT specialist from a US company who is sent to the UK subsidiary to help with the global rollout of a technology platform for a 3-month period. You will know from both examples that a short-term business visitor can be an inbound to the UK as well as an outbound to an overseas location. From here on, I will refer to short-term business visitors as STBVs, just so we use it as a shorthand. So STBVs come with all sorts of profiles in terms of duration of working arrangements and their role and seniority. So I've listed out some terms that you may hear reference to in your work for STBVs, such as cross-border workers, commuters, rotational workers, temporary employees, and stealth expatriates. The individuals themselves are likely not to refer to each other as one of these terms, so I will be helping you identify in your business, exactly who these individuals are so that you feel more comfortable in what you will need to do to keep your business compliant. The last of these terms, stealth expatriates, is the one that I've seen many times over my years. So when I started working in expatriate tax back in 2011, STBVs were just coming on the radar of businesses, and work with our clients was pretty much all about individuals on 2 or more years secondments up to this point. Increasingly, STBs have become discussed as a focus area, but often they are not handled by the global mobility professionals in organizations, and this can mean that there is a blind spot to them in companies. So there are some questions you should definitely start thinking about. For example, where do STBVs sit in your organizations? How are they monitored, and who is responsible for them? So this slide helps to emphasize the importance of the subject matter of our presentation. So this slide was taken from a joint survey that we conducted with the corporate relocation firm Santa Fe, and points to the fact that in the next 12 months, the biggest growth in international mobile employee movements will be STBVs, so short-term business travelers and individuals on short-term assignments. The more conventional sort of developmental long-term assignments and strategic long-term assignments are simply not seen as key growth areas at present. So let's take a look at why STBVs are an important issue. So from our experience, there are 4 main areas we can group our insights into: cost containment, policy adaptation, changing social trends, and technology. We can ask ourselves why STBVs have been on the rise in recent years. The reality is that companies have increasingly been focusing on return on investment in relation to global mobility. Conventional international assignments, what I referred to earlier as developmental long-term assignments and strategic long-term assignments, are generally 2 to 3 times more expensive than employing someone in a local position or sending individuals on short-term assignments. As an employer, you cannot guarantee that the assignment will not fail, which includes things such as the assignment objectives not being met, the assignment ending early as the assignee or their family do not adapt to the new role or location, or the individual leaving the business on repatriation, depriving the business of the long-term benefits they would have liked to have seen when the individual returns. Companies' increased focus on cost has pushed them to consider shorter and commuter-based assignments, which enable them to remove some of the significant assignment costs. There's also been a trend towards diversification of mobility policies within companies, aligning with the fact that there is recognition that commercial objectives can be met without deploying a conventional long-term assignment, where previously what might have been best served as short-term assignments might have been shoehorned into a different assignment structure. Companies now have greater versatility in relation to how they plan their international assignments. Increasingly, there are also social trends that have influenced how international assignments are structured. If I take the example of our own BDO offices, 10 years ago, we had a workforce which was working almost exclusively in the office from the same desk each day. We now have increasing numbers of staff working from home or working from different offices during a working week. Greater flexibility in the workplace can be performed by an individual in their home country, which goes hand in hand with employers being able to dispatch or deploy these employees overseas for key meetings or aspects of a project to be conducted at last-minute times. To add to this, the increasing prevalence of dual careers, a long-term secondment may aid the career progress of one partner but can represent a setback to the career of the other. A short-term assignment or short-term business trips can avoid a full relocation, of course, whilst having an impact on the working dynamics of a couple or a family. It can be more attractive to an employee who's keen to avoid their partner having to disrupt their career, or indeed children who may otherwise need to move to new schools in the assignment location. Of course, then you have the role of technology. While there will always be time zones and some meetings that need to be handled face-to-face, Skype, webinars, and paperless offices all ease the ability to work from home countries on projects for an office in another location. I wanted to also briefly touch on the moral debate and compliance angle to this. So business visitors have always been around, but have never been as much in the forefront as they are today. The moral debate has changed compared to a number of years ago. The current political focus on taxing global corporations was triggered a couple of years ago by the UK government calling the senior executives of the likes of Amazon, Google, Starbucks in front of the UK Public Accounts Committee. So Parliament was inquiring into the relatively low level of corporation taxes paid in the UK, given the high levels of commercial activity in the country. Despite some robust questioning and the actual executives were able to convince the committee that they were not doing anything illegal. They were in fact following the applicable UK tax law. So as we all know, that the committee was forced to withdraw the case. Now, yesterday's example of the EU taking Ireland's government to court over Apple's taxes fits perfectly to this moral debate, and will be certainly one that we all should watch out for. Then we come on to the power of the consumer. As you can imagine, this has triggered intense public backlash against multinationals continuing to pay so little tax. Citizens no longer unconditionally accept that companies with a very high commercial activity in certain jurisdictions pay very little amount of tax and shift most of their profits to tax havens. Companies face reputational risk with the general public, even when speaking they were sort of respecting the law. As I mentioned before, companies are expected to be fully tax compliant, and authorities now have the means to enforce that. The new OECD guidelines on base erosion and profit shifting, also referred to as BEPS, provide a new common legal framework for countries to try and tax where the economic value is created. I'll touch on this BEPS issue slightly later and how it all fits into short-term business visitors as well. Then we've got the automatic data exchange. So bilateral and multilateral agreements between countries to exchange data and information help these countries to enforce these new tax rules and regulations. So exchange of information is not only affecting tax data, for instance, with respect to dividends or interest paid by companies or banks to non-resident beneficiaries. We also then need to consider sort of the company legislation and practice. So when the authorities are sharing information on whereabouts of individuals, companies cannot sit still and do nothing. They are expected to know where their executives and employees have been and what they have been doing about that. And more importantly, they are expected to also comply with the resulting tax and social security consequences. So let's now have a look at some of the rules surrounding these short-term business visitors and travellers. So as we all know, tax treaties have been agreed to avoid double taxation for specific types of income. So for employment income, the right to tax is granted to the country in which the activity is performed. If, however, a number of conditions are met, taxation will remain in the employee's country of residence. One of these conditions is the notorious 183-day rule. This 183-day rule is often misinterpreted. So business visitors can indeed be exempt from taxation in the working state if they spend less than 183 days in that country. That's correct on the face of it, but spending less than 183 days in a certain country is not a guarantee that the employee is exempt under the treaty. That is the 183 days myth, effectively. Spending less than 183 days in a country is not enough. Other conditions will apply. Secondly, for business travellers to be exempt under the treaty, no economic employment relationship should be created between the employee and the entity in the host location. So in a scenario where an economic employment relationship is created, an employee is legally employed by a home country. Going back a step, in fact, so in this scenario where an economic employment relationship does exist, but the individual themselves is employed by the home country, so legally employed by the home country, visiting the host state where the host state is seen as the economic employer, can have an impact on their tax position in the UK. Now, elements that are used to determine whether such an economic employment relationship exists in the host location do include questions that we should ask each other sort of which entity bears the employment cost directly or indirectly. Now, you may have seen that by sending an employee to a host location, if they do create an economic relationship, in most circumstances, you would usually recharge a element of their cost, including other costs, to the host location under transfer pricing regulations. But there are also other ways of packaging up these recharges, such things as management charges. So if you do see those sort of charges in your sort of day-to-day job and you do have individuals moving, do question yourself whether there may be a tax impact in the host location. Other questions you should sort of ask yourself is the employee integrated into the business of the host entity? Who controls the employee? What activities of the employee form part of the business in the host entity? And who ultimately bears the risks and rewards of the work performed by the employee in the host location? These questions are part of the sort of OECD guidelines which overarch the double tax treaties in certain locations. So I would encourage you to start asking yourself these questions where you do see individuals moving across borders. And thirdly, no exemption will be available if the salary costs are borne by, as I mentioned, or allocated to a permanent establishment of the legal employer in the country where the activities take place. Now, permanent establishments fall into sort of corporate tax, but if you are aware of individuals that are traveling to host locations, in particular, senior executives or those who are integrated into the host location and benefiting that employer in the host location, then the sort of conventional way of thinking of, they're not physically signing contracts or concluding the contracts in the host country, therefore they're not creating a permanent establishment. That is also a thing of the past now. So since the introduction of BEPS, tax authorities across all sort of internationally have sort of honed down into these things and are starting to look at whether the employees are actually part of the negotiation stage of contracts. How integral are they to the business themselves? So please do keep all that in mind. So in summary, all three conditions need to be met simultaneously. The employee must have spent less than 183 days in the working state. No economic employment relationship should exist, and the salary cost must not be borne by a permanent establishment that the employee may create for the employer in the working state. Only then the employee is exempt under the treaty, and as you will have noticed, the recharge of salary costs generally will rule out the possibility of a treaty exemption. The treaty may grant a tax exemption for a business traveler to pay taxes in certain jurisdictions, but it does not necessarily exempt companies from withholding taxes on these employee taxes. So just to sort of throw an example in here, so if we did have an individual from Germany coming into the UK where they've spent less than 183 days, we could say there has been a cost recharge, or you've established that the UK is an economic employer, then UK payroll taxes will apply from sort of day one. But if we flip this on its head, the same individual coming from Germany to the UK, where they are less than 183 days, and there isn't a cost recharge or an economic employment relationship, the fact that there is a PAYE presence for the employer in the UK, the employer will still have an obligation to ensure that they report the individual to the UK tax authorities. And I encourage companies to sign up for sort of the short-term business visitor agreements, which helps relax the employer's obligations and sort of ensure that you continue to track their days so they don't actually fall foul to these rules thereafter. HMRC are actively looking at companies that don't have these short-term business visitor agreements in place. So I would encourage you, if you haven't done so already, to actually go back, identify, like I mentioned earlier, who's responsible for these business travelers, what they are actually doing in the host locations and who's responsible and how the company can get these agreements in place to become compliant. So earlier on, I mentioned the introduction to BEPS as well. So the two main areas I want to focus on is Action Point 7 and Action Point 8, 10, and 13. Action Point 7 I've sort of already covered, where historically companies had a view that by sending an individual into host locations, they're meeting suppliers, they're building new business, bringing in clients, but they're not concluding contracts. That sort of scenario is a thing of the past now, where permanent establishment wouldn't be created. From the introduction of BEPS, they've really tightened the rules on what an individual does in host locations, and one of the main areas they have concentrated on is the activities the individuals perform in their host location. On top of this, Action Point 8 to 10 and 13, transfer pricing outcomes. This is quite important because where an economic employment relationship is created, or there is a need to allocate costs to the host location, albeit for the individual's time there, it is important to ensure that this is done through an arm's length sort of transaction. HMRC are looking not only at large corporations where there is a need to be compliant with these rules, but also the sort of small, medium enterprises where historically there wasn't a need for them to have an actual transfer pricing policy, but they are concentrating a bit more on how the arm's length principle is applied. So what I'm effectively trying to show here is that by the movement of an employee, there isn't just income tax and social security consequences that you need to think about. There are also the wider implications of corporate tax and transfer pricing rules as well, which can actually impact a lot more of your other stakeholders, for example, the finance directors or other key members of your business. So in short, you shouldn't ignore business travelers as the tax implications are growing. Thank you.
Thank you, Claire. Thank you, sir. Claire, I think you wanted to just touch quickly on one of your previous slides. We'll go back to now in respect to non-cash vouchers.
Yeah, I just wanted to check you all awake this morning and see if you spotted a deliberate error on the slide. On the example at the top, we're saying it's agreed to a salary sacrifice. That should actually read £50 per month, not £45. So therefore, the example will now make sense, hopefully. So if you could just correct your slides. So apologies for the mistake, but hopefully you're on your toes and noticed it. Thank you.
Thank you very much. Had a couple of questions throughout the webinar that I just want to raise whilst we've got time. Claire, I think this one's probably for you. One of the attendees has mentioned they have a number of employees with MBA studies that they're financing via salary sacrifice. Currently, the MBA is tax-free, is exempt for work-related training. The last contract they actually went into was signed in October 2016 for 2 employees. They're now looking to set up another MBA for an employee starting shortly. They think it's all fits under Type A arrangements, but it's unclear how this is going to be treated.
Yes, a good question, and I think it's the type of scenario that will probably affect a number of employers. So firstly, to confirm, yes, the arrangement is a Type A arrangement, but then we need to look at the date that the new rules become effective. So we've got 3 people here. 2 of the employees were registered in October, I think it's October 2016, and therefore this is before the new rules were introduced in April 2017. So provided there are no variations to those kind of individual arrangements or contracts with the MBA provider, then the position should continue until the 6th of April 2018, i.e. the training will continue to be exempt from income tax and NIC. However, we've got the new person who will be signing up to the arrangement shortly. I don't actually say when, but it's obviously anticipated to be after the 6th of April 2017. So therefore, this will be under the new optional remuneration arrangement, Type A. So we have to do the comparison when working out the taxable value.
I think we've got time for one more question that we've had in. I think it's probably more for you, Suk. One of our attendees has a branch of the UK entity in Germany, and they're looking to send an employee of that branch to the UK to work just on a one-off project later this year. The assumption is that we're in line with the relevant conditions and can be reported under the STBV arrangement. Just wanted to ensure that was the case.
Interesting question, actually, making me think on my feet now. So, okay, so just sort of reflecting back on that, so a branch of the UK entity in Germany, so are planning to send an individual to the UK. So yes, under the actual double tax treaty exemptions, so just sort of going back a step, in fact, in order to apply the short-term business visitors conditions, there needs to be a relevant double tax treaty in place with both countries. So, for example, if you got individuals coming from Brazil, I can rule that out. The short-term business visitors won't apply, and from day one, you need to operate payroll. So, where there is a double tax agreement in place, so for example, in your situation, Germany and the UK, usually the rules will apply, provided the entities are two separate legal entities in each jurisdiction. But because the UK is the legal employer and they have a branch in Germany, the actual employer would be resident in the wrong contracting state. Therefore, the short-term business visitors agreement and the treaty conditions, in fact, won't apply. So in short, what I can say is that if it's a UK employer and you have a branch in other locations, then the short-term business visitor agreements won't apply. And in fact, from my experience, HMRC are actually actively looking into this. I've got actually 2 clients on the go at the moment who are experiencing a similar sort of issue. So yeah, please do bear that in mind. I'm more than happy for you to reach out to us if you need any further assistance there. Yeah.
Thank you. So thank you both. Thank you for your time this morning and to our speakers. Our next webinar is on 7th of December, providing a US tax update for professional services firms, which we hope you can join us for. The recording from today's webinar will be updated to our website shortly, and if you have any queries, please do let any of our speakers know or your usual BDO contact. Thank you very much.